Hello! Today we are going to be talking about the aging of accounts receivable method for estimating a company's uncollectible accounts, also known as bad debts. Before we get into a problem, I want to talk a little bit about what aging of accounts receivable means and where it falls in the different methods for estimating bad debts. So there are two main approaches for estimating bad debts, and they are the income statement approach, looking for information from the income statement to help us estimate bad debts, and the balance sheet approach, looking to information from the balance sheet to help us estimate bad debts. If the company were to elect an income statement approach, typically they will be using the percentage of sales method, where they'll most likely look at their credit sales in a given period and estimate some percentage to ultimately be uncollectible. Of course, sales is a revenue account and appears in the income statement, which is why percent of sales is classified as an income statement approach. If the company were to elect a balance sheet approach, then they will typically be using one of two options. First, they could decide to estimate bad debts based on a percentage of their current accounts receivable balance. This makes sense because if the company has a large balance for receivables, it means more of the balance will likely be uncollectible. The other balance sheet method, which will be the focus of this video, is the aging of accounts receivable method. Aging of accounts receivable essentially uses the same idea as the percentage of accounts receivable method, except aging is much more detailed and uses several different percentages depending on how far past due the account is. We will see the details of aging in just a moment when we look at a problem. Of course, both of these two methods are considered balance sheet approach methods because accounts receivable is an asset account which appears on the balance sheet. Now, both the percentage of sales and the percentage of receivable methods were covered in a separate video, so if you're interested in seeing how those methods work, you can go and check that video out. So next I'm going to show you what aging of accounts receivable looks like, including a short problem. So here we see the aging analysis. And in the amount column, this shows different amounts of accounts receivable. So if we were to add up all these numbers together, we would get the accounts receivable balance that would show up on the balance sheet. Now, along with accounts receivable comes a due date. And we see here that $290,000 of this company's accounts receivable is not yet due. And they estimate that 0.5% of the accounts receivable in that category will ultimately be uncollectible. Next, we see that $15,000 of this company's accounts receivable is between 1 and 30 days past due. And that means that these are customers who have missed their due date. But of course, the company is still going to try to collect the balance from them. And they estimate that 1% of the accounts receivable in this category will ultimately be uncollectible. And that's a little bit higher than the past category of 0.5% when they were not due yet. And that makes sense, because if the customer is a little late on their payment, that might increase the chance that they will ultimately not pay. And then we have the further categories of 31 to 60 days past due, 69 to 90 days past due, and more than 90 days past due. And as you can see, the percentage increases as the account gets further past due. It looks like the company in this problem has a very effective collection strategy, as they can collect almost all of their late accounts, with only 2.5% of their accounts receivable that are more than 90 days past due classified as uncollectible, which is quite good if you ask me. Now, these percentages are not set in stone. They would change based on each company. So the company is usually going to estimate these based on their past records. So this company is saying that, okay, of all the accounts that are usually not due yet, usually about 0.5% of those are not going to be collected. So we're going to apply that to our amount right now. And the way we do that is we take the amount, 290,000, and we multiply that by 0.5%, which ends up being 0.005 if you were to convert that to decimal form. And when you do that, you find that this company estimates that $1,450 of the accounts receivable that's not yet due will ultimately be uncollectible. And you can do a similar process to the remaining accounts. So we have $15,000 of the accounts receivable that's between 1 and 30 days past due, and we can multiply that by the 1% that's estimated not to be collectible, 0.01 if you were to convert that to decimal form for your calculation, and that gives us $150. And we can do the same process for the remaining ones to get these remaining numbers. So hopefully you can see how this is similar to the percentage of accounts receivable method. We still are taking a percentage of accounts receivable, but we're just being a little bit more specific with it. So we're splitting our accounts receivable into all of these categories and then taking a percentage for each category. So in theory, this should be more accurate than just using the total amount because we've taken in more information here. Alright, the next thing you want to do once you've estimated the amount that's uncollectible for each category is to add all those numbers up together. So when we sum them, you get $1,775 of the total accounts receivable that this company estimates is uncollectible. So the question says, prepare the year-end adjusting entry on December 31st to recognize bad debts under the following independent assumptions. And of course, this is going to be based on the aging of the accounts receivable. So first they say the allowance for doubtful accounts has an unadjusted balance of $350, and that's on the debit side. So here, if I was to zoom out a little bit, you can see that I've made a T account for the allowance for doubtful accounts, and that's showing the $350 debit balance. Now we've already calculated that $1,775 of our accounts receivable is ultimately going to be uncollectible, and that becomes the balance for the allowance for doubtful accounts, since that account represents how much accounts receivable is uncollectible. And that's going to be on the credit side because the allowance has a normal credit balance. It's contra asset, contra to accounts receivable. So accounts receivable has a normal debit balance, and the allowance is going to have a normal credit balance. So this number always goes on the credit side after we've made some adjustment. Now we have to figure out, well, what does that adjustment have to be? And the adjustment has to be, well, some number on the credit side. So we have $350 right now, and I think of this as $350 in the hole, this $350 debit balance. So what we end up having to do is take the $1,775 and add that to $350, and that gives us $2,125. And you'll see now if you take $2,125 and you subtract $350, that does give us that desired balance of $1,775. So the adjusting entry is always going to look the same way for the two accounts. It's going to be bad debt expense for the debit of $2,125, and the credit is going to be the allowance for doubtful accounts, and that's also for $2,125. Moving on to part 2, it says that the allowance for doubtful accounts now has an unadjusted credit balance of $350. So we're seeing that right over here. And so what we're going to do is we're going to again put this $1,775 on the credit side as our desired balance. And we're going to need a number to add to the 350 to get us to 1,775. So if you take these two numbers and you subtract them, 1,775 minus 350, that tells us that our adjusting entry is going to be for $1,425. And you can see that makes sense because if you add these two numbers together, it does add up to our desired balance of $1,775. So this is going to be the same two accounts as last time. That's bad debt expense. That's for $1,425. And then we have the allowance for doubtful accounts, also for $1,425. Alright, we are finished with the journal entries. And the last thing I want to say is that the aging method for estimating bad debts is typically going to be the most reliable method. And the reason for that is because it takes into consideration a lot more information. We have all these different categories and all these different percents that relate to the accounts receivable in each of the categories, which is usually going to be better than just simply taking a percentage of your entire accounts receivable or a percentage of your credit sales. But of course it comes at a cost, because you have to take the time to estimate each of these percentages, and if the percentages you estimate are incorrect, then also your estimate is going to be incorrect. So there are both advantages and disadvantages. The advantage being that it's going to be a more accurate estimation. The disadvantage is that it's going to take a little bit more work to prepare an aging analysis.